It's been a cruel October for buyers, with average 30-year mortgage rates spiking on job market strength, stubborn inflation, and rising U.S. debt levels. Looking on the bright side, however, inventory levels continue to rise and competition levels are falling. Average 30-year mortgage rates jumped 75 basis points over the last month and are approaching 7% again. All this despite the Fed cutting rates by 50 basis points on September 18th. The much stronger than expected September jobs report started the sell-off in bond prices, and the latest inflation report added fuel. But lately, the concerns have been focused on the U.S. rising debt levels. Since the Fed cut rates in mid-September, average 30-year mortgage rates have moved up from 6.11 to 6.92%. Why? That's the question everyone's asking. Here are 4 responses, which in some combination could help explain this unwelcome move. Typical post-Fed rate cut moves. As conflicting as it sounds, it's fairly common for Treasury bond prices to fall and mortgage rates to rise immediately after the Fed initiates a rate cut cycle. It's a buy on rumor, sell on fact phenomenon. In this case, the market had already priced in multiple large rate cuts before year-end. Unsupportive data since the Fed cut. The September BLS jobs report that came out on October 4th was a blowout. 254,000 jobs added with unemployment rate at 4.2% from 4.1%. Then the latest inflation report saw core CPI rise from 3.2% year-over-year in August to 3.3% year-over-year in September. Would the Fed have cut rates 50 basis points if they knew this report was coming? The October effect. Historically, October has been a bad month for financial markets. The 1929 stock market crash and Black Monday in 1987 both happened in October. And in each of the last 3 years, bond prices have gotten hit hard in October. Recall that in October 2023, the average 30-year mortgage rates peaked at 8.07%. Election-related fears. Who will increase the annual deficit most? Neither candidate is addressing this. Sadly, advocating for a balanced budget is not popular to voters right now. Would a Trump victory stoke inflation to levels we have never seen, or would a Harris win push our national debt even higher? Despite declining mortgage rates in the preceding 4 months, existing home sales in September failed to revive, falling 1% month-over-month to a seasonally adjusted annualized rate of 3.8 million units sold. This pace of sales is actually below 2008, when transaction volumes bottomed after the housing crash. The median sales price for existing homes in September fell 2.3% month-over-month to $404,500, but that was up year-over-year by 3%. The Northeast saw the strongest price growth and the South saw the weakest. Competition always wanes in the fall and winter, but the September 2024 Realtors Confidence Index showed that homes were seeing fewer multiple bidders and a slower pace of sales compared to the same time last year. There are fewer people competing for properties, only 20% of homes sold above their listing price, and homes are lingering on the market longer. This is more than just seasonal. The average home sold in September 2024 had 2.4 offers. That was the same as in the prior month, August 2024, but was down slightly from 2.6 in June of 2023. 20% of the homes sold in September of 2024 transacted above the initial listing price, same as in August of 2024, but down from 26% in September of 2023. The market's getting back to normal, where sales prices on average are 95 to 100% of the listing price. The typical home sold in September 2024 had been on the market for 28 days. That was up slightly from 26 in August 2024, and up significantly from 21 in September 2023. Keep in mind that a higher days on market number indicates a slower pace of sales. Thanks for tuning in to my Mortgage and Housing Update. My name is Pauline Lee. I'm a real estate professional with an expertise in financing. Connect with me for a consultation and to get mortgage ready. I encourage you to get pre-approved.